Disclaimer: the date is December 23rd, 2025. Silver just did something it hasn't done in 45 years. It broke through $70 an ounce, hitting a specific high of $70.45. That marks a staggering 140% gain for the year. You'd think this would be celebrated as a straightforward supply shortage story, right? Metal gets scarce, prices explode, case closed. But here is where reality gets strange. At the exact moment silver is hitting these historic highs, the Comex commodity exchange in New York is supposedly sitting on 517 million ounces of the metal. That is the highest inventory level we have seen since late 2020. Think about that for a second. Record prices, record inventory. These two facts shouldn't exist in the same sentence. Pop quiz. What happens when you have an abundant supply of something? Prices go down. It's the most basic principle of supply and demand. Yet, here we are, watching silver vault past its 1980 inflation-adjusted peak, while warehouses in New York claim to hold more of the metal than they have in 5 years. Something doesn't add up, and Wall Street knows it. The question isn't whether silver is expensive. The question is why it's expensive when there is supposedly so much of it sitting in vaults. In the next 15 minutes, we are going to expose the accounting trick that hid the silver crisis for a decade, the 3 technologies draining the world's supply, and the mathematical inevitability of 3-digit silver. Let me paint you a picture of what happened in early December. In just the first 4 trading days of the month, something unprecedented occurred at Comex. Traders showed up demanding physical delivery of their silver contracts, not cash settlement, not rolling their positions forward, but actual metal in their hands. They claimed 47.6 million ounces. To understand how shocking this is, you need to understand the dirty little secret of how Comex counts its silver. They use 2 categories, eligible and registered. This distinction is the key to the entire illusion. Eligible silver is metal sitting in Comex-approved warehouses, but it is privately owned. It might belong to a wealthy family office, a foreign bank, or a private investor. It is stored there, yes, but it is not available for delivery against futures contracts. It is essentially dead inventory. Registered silver is the only thing that matters. This is the metal that has a warrant attached to it. It is the pile that is actually available when contract holders say, "I want my silver now." Here is the trick. For years, the media has reported the total inventory, combining both numbers to make the stockpile look massive. But when those December delivery demands came in, they didn't pull from the big pile. They pulled from the tiny registered pile. That demand consumed 60% of all available registered silver in just 4 days. Analysts started using a term we haven't heard since the Hunt brothers tried to corner the market in 1980, vault drain emergency. This isn't normal market activity. This is panic buying dressed up in suits and ties. Someone out there, likely a major industrial player or a sovereign nation, doesn't trust the paper anymore. They want the real thing, and they are paying a premium to get it. You might be asking a logical question. If the price is $70, why don't mining companies just dig up more silver? This is where the story shifts from finance to geology, and the reality is terrifying for anyone expecting a quick fix. Silver is a freak of nature in the mining world. Unlike gold, which is mined for the sake of gold, silver is rarely found in pure deposits. Roughly 70 to 75% of the world's silver comes as a byproduct. This means miners are actually digging for copper, lead, or zinc. The silver is just an accidental bonus they find in the dirt. Here is why that matters. If the price of silver doubles, a copper mine isn't going to double its production just to get a little bit more silver. Their economics are driven by copper prices, not silver prices. This makes silver supply inelastic. The price can go to $100 and supply won't budge because the primary mines are focused on other metals. Furthermore, we are facing a crisis of ore-grade decline. 20 years ago, for every ton of rock you crushed, you might get 15 ounces of silver. Today, you are lucky to get 4 or 5 ounces. We have picked all the low-hanging fruit. The easy silver is gone. For 5 consecutive years, from 2021 through 2025, the global silver market has been in a deficit. We have consumed 820 million ounces more than we have mined. We survived this deficit by draining above-ground stockpiles, but now those stockpiles are gone. The cupboard is bare right at the moment demand is about to go vertical. We are entering a new age of technology, and unfortunately for the supply chains, silver is the most conductive metal in the known universe. It is irreplaceable. Let's look at solar energy. You've heard about the green transition, but you probably haven't heard about TOPCon technology. This is the new standard for solar panels being rolled out in 2025. These new high-efficiency panels require 50% more silver per unit than the old PERC panels. In 2014, the solar industry used 11% of the silver supply. In 2024, it hit 29%. With the new technology standards, projections show solar alone could consume 50% of global mining production by 2027. But the real dark horse, the demand source nobody priced in, is artificial intelligence and defense. We aren't just talking about chatbots. We are talking about the physical infrastructure of AI, the massive data centers, the 5G towers, and the advanced circuitry needed to process trillions of operations per second. Silver is the only metal that can handle these electrical loads without overheating. Then there is the military aspect. In a world of increasing geopolitical tension, smart missiles, drones, and satellites are the priority. Each Tomahawk missile contains roughly 15 kilos of silver. Unlike the silver in your grandmother's spoons, this silver doesn't come back. When a missile explodes, that silver is vaporized. It is gone forever. We are literally blowing up our precious metal supply while demand hits record highs. So we have a geological limit on supply and an exponential explosion in demand. How did the market signal this? It happened in October 2025 with a phenomenon called deep backwardation. In a healthy market, you pay more for something to be delivered in the future because you have to pay for storage and insurance. This is called contango. Backwardation is the opposite. It happens when the cash price for immediate delivery is higher than the future price. It is the market screaming, "I don't care about next year. I need the metal now, and I will pay a penalty to get it." In October, the backwardation in silver reached levels we haven't seen since 1980. At one point, traders were paying a $3 premium just to skip the line. Historically, whenever silver enters backwardation, a massive price squeeze follows. It happened in 1980, it happened in 2011, and it is happening now, but on a much larger scale. Traders noticed that the EFP spread, the cost to exchange paper contracts for physical metal, jumped from 2 cents to nearly $1. This is the real price asserting itself. The paper price on the screen is becoming irrelevant. The physical price, the price to actually hold the bar in your hand, is decoupling from the futures market. So, where is this heading? Based on the structural deficit and the historical data from previous squeezes, we can map out 3 phases for 2026. Phase 1 is the panic buy. This is where we are now. Industrial users like Tesla, Samsung, and solar manufacturers realize there isn't enough metal to go around. They stop buying just in time and start buying just in case. We project this pushes silver to $85 by Q1 2026. Phase 2 is the short squeeze. There are massive banks that hold short positions on silver, betting the price will drop. As the price rises, they face billions in losses. They will be forced to buy silver to cover their bets, fueling the fire. This is the mechanism that could drive silver to $120 by mid-year. Phase 3 is monetary rediscovery. This is the long game. If inflation persists and trust in sovereign debt continues to crumble, silver returns to its historical role as money. Adjusted for real inflation, the 1980 high of $50 would be closer to $200 today. That is the long-term target if the paper market breaks completely. We are conditioned to think of $70 silver as expensive because we remember when it was $20. But that is recency bias. When you look at the 820 million ounce deficit, the collapsing ore grades, and the impossible demand from the green energy revolution, $70 isn't a bubble, it is a floor. The illusion of the 517 million ounces in the vault has been shattered. The eligible silver isn't for sale, and the registered silver is disappearing by the day. The abundance was a lie. The scarcity is the reality. The train has left the station, but for those paying attention, the journey is just beginning. This is InvestEdge. Subscribe to see what the data reveals next.